Let us begin this week's silver report with a look at the paper silver markets, which are pretty much dead in the water, which is a good thing. See here a 6-month look at the SLV ETF. On the top here, we have the price per SLV share. We are now at $22, $21.99 as of, I think, Wednesday, December 14th. You can see what has been happening to the holdings of this fund. The silver holdings of SLV have fallen significantly since July, but especially since the bottom. We have here, it looks like around 466 million ounces, and here we have about 469 million. It hasn't gone up pretty much at all since silver bottom back in September at 16 and a half an hour at 22. This is a significant rise in the silver price with almost no relative rise in the SLV fund. And in the past 3 days, it looks like we've had almost 4 million ounces drained out. And now here is the really cool thing. This is a long view on the SLV ETF, and here, so you can see what is going on here historically, right? We've had a huge drive higher in SLV reserves here, and the amount of baskets, the amount of silver that's supposedly in the fund. Since March 2020, we had a huge influx, one of the biggest on record. And here, of course, the silver squeeze with that huge spike when SLV apparently put in, was it like 140 million ounces or something in a day? Do you really think they did that? Let's just leave that up to speculation, shall we? But here's the point. You see here this pretty healthy rise in the silver price. Looks like we have a head and shoulders bottom here. Here's the head, these two little arcs or the shoulders. So possible head and shoulders bottom here, and then a very strong rise up. So during this rise in the silver price, we've had pretty much no rise in the silver reserves of the fund. Very unlike what was happening from March 2020 through silver squeeze. Since silver squeeze, SLV interest has waned, which means that the paper traders still have yet to enter this market, and so the move, it probably is a long way from being finished in the technical sense. Now let's move to Powell. He's not thinking about something again. Let's see exactly what it was.
Changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. I think this isn't the time to be thinking about that. There may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're gonna keep our inflation target at 2%, and we're gonna use our tools to get inflation back to 2%.
By thinking about changing the inflation target, not even thinking about it, without thinking about it.
We're not even thinking about raising rates. Changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. I think this isn't the time to be thinking about that.
Now let's move to Austria, where it says, according to Reuters, inflation uncertainty fuel new gold rush at ancient Austrian mint. Key paragraph here, at the moment, every gold coin that comes off the coining press has already been sold, said Starsick. He's the chief executive of the Austrian Mint. Right now, we could sell 3 times as many as we are able to produce. That's just another way of saying there is a gold shortage in Austria. If you're selling more than you can produce, then not everyone willing to buy can get what they want, and so there is a gold shortage. What is the cause of this? The low spot price. I'm going to go over one more line from this article and debunk it. This is still Starsick talking, and he says the final paragraph here, he said he believed more Austrians were seeking to include gold or silver in their portfolio as a hedge against stocks which diversify their portfolios. Many analysts doubt the usefulness of gold to counter inflation, however. And so they gotta stick in that last line, the usefulness of gold for countering inflation. But that whole terminology doesn't make any sense. It is a nonsensical statement. Gold does not counter inflation. Silver does not counter inflation. Inflation is the inflation of the gold and silver substitute on top of the gold and silver supply. So gold and silver are not inflation hedges. They are simply money that is not inflated. So how do you counteract? How do you escape inflation? You get money that isn't inflated by definition, and eventually it pays off handsomely in terms of the real assets that can be acquired. Remember Zoltan Pozar's theory that Russia could peg the dollar to gold as a way to circumvent the $60 price cap on his oil. This just came across my Twitter feed from Financial Juice. Kremlin. Putin decree on a response to the oil price cap is still expected this week. That is December 15th. You're watching this on December 16th, so maybe it'll be over the weekend. Maybe you already said it. Maybe it'll be Sunday. Who knows? We'll see. It's coming up soon. There's something that he's going to be saying, going to be sharing. And if he says that he's going to be trading his oil for gold, it's going to change the world. I don't know if he's going to do it. I doubt that he's going to do it because it seems a little bit too good to be true. There are other concrete moves that Putin is making, and that is here. Russia offers to help India get hold of a big oil tanker so it can dodge the EU price cap rules. How does helping India build large tankers help them circumvent the $60 price cap rules? Well, because the price cap isn't really on the oil itself or on countries that buy the oil. It's not like the US or its allies are going to bomb countries that pay more for Russian oil. It's that the US and its allies are forbidding insurance companies from insuring oil at over $60 a barrel. So they can only insure up to $60 a barrel, and no one's going to transport oil across the world if that supply isn't insured. So by building its own oil tanker fleet, it can insure its own oil without being reliant on US or European companies. And so this price cap, first of all, is encouraging India and Russia to build their own capital system that can trade oil outside of US and US dollar influence. This dichotomy, the two ways of looking at this, is a rehash of the 1960s Keynesian argument that gold will fall to $5 an ounce once the link to the dollar is broken. So in the late 1960s, there were these gold commissions and senators and congressmen asking questions from economists about what happens if we go off the gold standard, what happens to the price of gold. Well, they looked back at the crime of 1873 when silver was demonetized in favor of gold and said, oh, look, silver went down in 1873 when we delinked the dollar, when we severed the connection between the dollar and silver. And so if you sever the connection between dollar and gold will go down too, because if it's not connected to the dollar, which is the ultimate asset in their Keynesian eyes, then who needs gold if you don't get dollars for your gold? But the point is, you don't get dollars for your gold. You get gold for your dollars. So if gold is delinked from the dollar, obviously the price of gold goes up. And they were wrong about that in the 1960s. But it's the same thing here. In the oil-dollar equation here, they're thinking in the US and Europe that the dollar is the ultimate asset, that if the Russians don't have access to the dollar, they're going to suffer. But really, gold is the ultimate asset. So if they help India produce its own transport system for oil, building its own tankers, and they have the capital, and they can circumvent the entire dollar system and trade in gold. They should just trade in gold. So never underestimate Keynesian hubris. They think the dollar is the ultimate asset until the end of time when hyperinflation destroys it, and they will go down with the ship as India and Russia build their own.